Okay, good morning, everyone, and welcome to this morning's edition of the Coffee Microcaps Morning Meeting. You're all very welcome. For anybody who's joining us for the first time, you're very welcome. And for any of our regular attendees, welcome back to this morning's event. My name is Mark Tobin. For anybody who's joining us for the first time, I'm the founder of Coffee Microcaps. I'm just going to run through a couple of intro slides here, and we're going to get straight into it with our first presenter. I'd firstly like to mention DMX Asset Management, our sponsor for all our virtual events here at Coffee Microcaps. If you are looking for a small or microcap fund manager, please do check out the DMX website, or indeed get in touch with Stephen or Michael directly for the relevant PDS on their two funds. Quick compliance and disclaimer slide. For anybody who's joining us for the first time, just a recap of the companies we normally have presenting here, generally on a weekly basis, capped under 300 million in revenue and approaching cash flow break even, or indeed are already profitable. We generally don't have companies from the resources or biotech sectors, what I like to call industrial microcaps, which covers all the other kind of sectors you can think of: financial services, healthcare, technology, industrial services companies, industrial products businesses, the full gambit kind of outside of resources and biotech. We generally follow the same structure, so we've got companies presenting generally every fortnight, sometimes even weekly, depending on the time of year. Each company gets a 30-minute slot, which we break down to a 20-minute prezzo and 10 minutes of Q&A. If you do have any questions for our presenters in the Q&A section, please type them in the Q&A box rather than the chat function. Just makes it easier for me to moderate the questions to our presenters. And please note the webinar is being recorded and will be posted on the Coffee Microcaps YouTube channel tomorrow. You can follow us on pretty much all the socials: Twitter, YouTube, for the recording of this webinar, and indeed we've got 80 other webinars up there now, so well over 100 companies if you're looking to delve into a couple of more ASX microcap companies. LinkedIn, and I also write a free monthly newsletter that you can get on the Substack platform. First up, we're going to have a returning presenter, actually, Will Creedon, CEO and founder of Alloggio. After that, then we're going to head up to the Northern Rivers, Grafton. Another returning presenter, Jim Bindon and John Lorente from Big River Industries. After that, then we've got Chris Noone will be joining us for the first time from Carley Holdings. Then we're going to head out west to Perth. We've got Andrew Booth returning to give us an update from Advanced Braking Technology. And then we're going to wrap up with another new presenter, Adem Karafili from Top Shelf International Holdings. So with that, I'm going to stop sharing my screen and hand over to Will. Will, if you want to start sharing your screen, I'll let you know when I can see the cover slide of your prezzo.
Good morning, Mark.
I can see it there now, Will, and your audio sounds good, so you're good to go, mate.
Thank you, Mark. Good morning, everybody. As Mark said, my name is Will Creedon. I'm the founder and chief executive officer of Alloggio. Alloggio is the leading operator of short-term rental accommodation here in Australia. We founded the company on the 21st of December 2015 and immediately went about creating our technology platform that would allow us to provide a whole range of different property services, both for the holiday properties and for the management of hotels. Just a quick snap on the last 12 months. Firstly, we gross booking value of $61.9 million, which is a 150% increase in the previous year. Our gross revenue grew 146% to $27.9 million. Our statutory EBITDA, $11.2 million, 113% increase. And very, very pleasingly, from day one, we've always been a profitable company. We had net profit of $2 million, which is a $1.9 million increase in the previous year. What drives this is our properties. We finished on June 30, 2022 with 1,883 holiday homes and 428 hotel rooms. Just to give you a snapshot of the last 12 months to June 30, we started on the 1st of July 2021 with 740 homes and grew to 1,883 homes, which is a 154% increase. some key milestones through the year. We listed on the Australian Stock Exchange on the 29th of November last year, raising $16.5 million. We immediately went in December, acquiring Great Ocean Road Holidays. In January, we built an already existing business in Noosa and acquired ACOM Noosa, Fairshore, and Noosa International Resort. In February, we entered a new geography into the Magnetic Island, and acquiring the best of Magnetic. At the same time, we actually built out our vertical. We purchased a car hire business on Magnetic Island. Right, what is very, very important for our business is that security and consistency of the supply chain to ensure that our holiday homeowners always have the best available linen and services to offer the travelers, the guests. And that car hire buyer sits alongside linen companies and other such companies. It's great revenue, slightly tighter EBITDA margin than the holiday business as well as the hotel business. Also in February, we increased our debt facility to $17.65 million. From day one, way back in 2015, we've always had a very, very strong relationship with the Commonwealth Bank of Australia. That continues today. As well in February, on the 23rd of February, we offered guidance to the market that we would achieve $21.5 million revenue and $8.6 million statutory EBITDA. We improved on that guidance in June, raising it to $26 million gross revenue and an EBITDA range of $10.5 to $11 million. And you can see from the previous slide that we beat those two indicators. This slide takes you across where we are in the east coast of Australia. The navy represents our holiday properties and the light blue represents our hotel locations. The logos that are captured across the ocean are what we have acquired since July 1, 2022 to today. There is one major acquisition that's not here, which I'll talk about later in the piece. What I want you to concentrate on this slide is where we're not in Australia. There's a large continent, and we as Alloggio wish to go where Australians travel. Now about future and the growth. Firstly, the short-term letting industry in Australia is extremely fragmented. In fact, it's extremely fragmented across the globe. There's 20 million holiday homes around the globe, 500,000 holiday homes here in Australia. And what Alloggio believes is that Australian TAM is 140 homes. And that is premium, medium to premium to upmarket homes. Today, we only have as of the 30th of June, we only have 1.35% of the Alloggio TAM. So there's a long runway. Over the last 10 to 20 years, there has been some digital transformation. No question, the bulk of it has been towards what we call the online travel agents or the OTA. Such an online travel agent, for example, is Booking.com, Airbnb, Stays, whatever, etc. And two very important points here. Number one, of the 500,000 holiday homes that exist in Australia, less than 50% of them are on an OTA. The second point is, of those 500,000 holiday homes, less than 25% are on more than one online travel agent. And this is where Alloggio comes into its own. Because of our technology platform, we can take individual holiday homes, list them on our platform, and then list them not on our websites and marketplaces, but also on every online travel agent, driving further bookings for the holiday homeowner. Alloggio. As I mentioned earlier, we're both in holiday homes and hotels. And what we do is we run a hub and spoke. The spoke is where we have either an office or a property on the ground. And from there, our team go in and out of each individual holiday home to inspect it prior to the arrival of the traveler, the guest, or the owner, to make sure that our contracted cleaners, and in some cases, our own housekeepers, have done the job properly. We also ensure that we can continue to liaise with the local vendors in the area to make sure that we're amongst the community and their children that are going to school are going to school with our team members' children. So there's a continuous relationship into regional and rural as well as metro and urban areas. From there, we also use that flagpole on the ground in those areas to create new listings, to drive organic acquisition of individual property homeowners. Centrally, what we do is we take the reservations, we manage the finance into statutory trust accounts, we manage the pre-arrival, the post-departure experience for all of our travelers and guests. We also ensure that we price the properties, hotel rooms, holiday homes, etc., through dynamic pricing, supply and demand, and we generally market and partnership from our central team. From day one, we've been consistent with these 4 pillars of growth. We will continue to acquire holiday property management rights to ensure that we can drive more efficiencies and more productivity, both for our holiday homeowners as well as Alloggio by default. And finally, we will continue to invest in reasons for travel through digital marketing strategies. This slide here takes you through our key operating metrics. I'm going to take it across from left to right. Our gross booking value, way back in June 2019, was $11.6 million. Today, it's $61.9 million. Our gross revenue, which is the chart in the middle, you can see on the 30th of June 2019 was $3.3 million. On the 30th of June this year, we reached $27.9 million, 103% compounded annual growth rate. Our number of properties, as I mentioned earlier, for example, in holidays, have grown from 510 properties on June 19 to 1,883 properties on June 30. Our hotel rooms have grown from 197 in June 2019 to 428 on June 30. And I'm going to just quickly run through our financial performance, both from the P&L, balance sheet, and cash flow. The most important thing here really is that we have been profitable from day one, and we will continue to be so. Going from $100,000 to $2 million in the last financial year. This slide is our cash flow, and really what I'd like to point out is that our cash from operating activities is $8.1 million, free and available cash to continue on our road of building on our 4 pillars of growth and expansion. And the numbers that I'd like to draw out here, one, even though we raised $16.5 million on the 29th of November last year at the IPO, we still today, on June 30, had $15.5 million of available capacity to continue to fuel our growth and expansion. Some leading takeaways before I talk about our announcement of last week. As you can see, we're in an area that has got some very, very compelling fundamentals. It's extremely fragmented. Here in Australia, we have Alloggio has a total addressable market of 140,000 properties. We are already one of the leading, if not, we are already the leading short-term letting company. We already have built our technology platform. We already have our team in place. We already have a very, very strong foundation of growth with 1,883 holiday properties, 428 holiday homes. And we had, at the end of June 30, $15.5 million in capacity. I'd like to now quickly go through an announcement we made last week, and that is Alloggio last Thursday acquired, exchanged and settled on the acquisition of a Perfect Stay and boutique stays. A Perfect Stay based in Byron predominantly, with flagpoles in Gold Coast and into Melbourne. Established in 2004, it grew to become one of the leading and reputational holiday management companies across Australia, and has been under steady and dedicated leadership from day one. Today, it has grown to almost between 277 and 300 properties. It has welcomed over its time over 1 million room nights and about 55,000 bookings or so. It's well established in its geographies. What it does for us, for Alloggio, it continues to build out our locations across Australia. It also adds to it some very, very significant tourism destinations, as I mentioned, to our portfolio. It brings to it some fantastic talent that all of the employees have been employed in, and over time, their experience and knowledge will spread to the rest of Alloggio Group. With boutique stays in Melbourne, in particular, it allows us to get into the urban market of Melbourne. It also allows us to enter into some very, very strong corporate relationships and partnerships, be it from insurance companies, be it from relocation companies for senior executives, etc. So it continues to add a further bow to our armory. And Mark, I suppose what I'd like to say now is thank you. And if you have any questions after this podcast, you can reach me on company secretary at alloggio.com.au. And Mark, over to you for any questions now.
Thanks, Will. Yeah, the questions been flying in as you've been talking there, so we'll try and get through as many of them. One, impact of proposed STRA changes for Byron Shire on the most recent acquisition. So a bit of a regulatory question on what's happening up in Byron.
Yeah, very, very good question. Firstly, all regulatory got the compliance regulation legislation is dealt with by the state government through the Department of Planning. There is input and there is influence from the Department of Fair Trading as well. The council that operates in the Byron Shire has put out to its residents a proposal that potentially that it would wish to reduce it from certain areas from 180 days to 90 days. However, that reasoning and that decision is with the state government. And I feel very, very strongly that following intensive research and consultation with all parties, that the purchase of Byron Bay, our perfect stay at Byron Bay, is in good hands as continuity of the past and regulation will continue.
Okay, and let's move on to the next one. You mentioned you're doing capital light deals in mid-market hotels. How many rooms do you now have under that structure?
So firstly, Mark, yes, we are. When we started the business way back in December 2015, I entered into commercial leases for hotels and motels. Following us listing on the exchange last November, we as a board made a strategic decision to move away from continue with our existing commercial lease hotels and motels and continuously analyze them. That's number one. Number two, but enter into new properties through what is commonly known in the industry as hotel management agreements. But Alloggio has put its own slant on it. One, because we can utilize our central technology platform and our people to ensure that we can bring our talent across all different properties to our technology platform. And so therefore we create accommodation management agreements. And over the last little while, we've been adding and beta testing that. And we'll have more to say on what we've added when we announce our half-year results in February. But all I'll say is that it's been a very, very strong interest, and we've secured a number that we'll talk about in February. But as you said, they're capitalized. We do not use any of our capital for them.
Okay, perfect. And this, I might tag on to the end of this next question. How far out from the stays date are guests now booking versus 12 months ago? And does this mean you've less forward visibility? So that's the first part. And then if I could just add on to it, maybe if you can just give us a sense of how the kind of summer season is picking up, and if, you know, what we saw in Europe this summer in terms of, you know, incredible amounts of travel and holidays after COVID, you know, looks like it would, that trend would kind of repeat itself now in the Southern Hemisphere summer season.
Yeah. So firstly, we're going into December, January, February very strong. Just a bit of a backdrop first. The last 2 years in Australia, at this time we were coming out of lockdown. So for example, in New South Wales last year, the New South Wales government, I suppose, let us rip from the end of October, and there was a boom November, December, January. What we've seen right across in regional and rural areas across Australia, and this is a generalized comment now, is that we've seen the return of the sort of 2016 to 2018 booking patterns, and that includes length of stay. Now that we're in December, you're seeing that it's bookings are coming in 20 to 48 days, which is typical of, for example, the habits of 2018. The other side that we're seeing is that people are taking slightly shorter booking lengths, meaning it's down to about 4.6, 4.8 nights. And that's varied in the type of accommodation they're purchasing. What I mean by that is one bedrooms are much shorter stay and much pace, which is when they book to when they stay is much shorter. Whereas 3, 4, and 5 bedrooms are still up around that 5.25 to 5.6 room nights, and they're at the higher end of the pace, meaning they're above that 45 to 55 because they're usually traveling either with extended family or clusters of couples coming together and their kids. And what we're seeing is in that last part, what I was just talking about there, we're seeing that not just here in Australia, but across the world. And it's a typical thing when people come under pressure from what's in their wallet, meaning inflationary pressures, mortgaging pressures, etc., or retail contraction or retail spend. It's similar to what happened way back in 2009 to 2012, and again what happened in 2001, 2003. So you can see the returning in those habits, which was only always going to happen. So all we're seeing is the normalization of what travel was doing 2019, etc. And we as Alloggio, you know, when we acquire businesses, we're acquiring in an EBITDA range of 4.5 times EBITDA, and over a number of years, and then we're by the use of Alloggio's technology and its scalability and its efficiencies over the fullness of time, about a year and a half, because of the amount of bookings, how long it takes bookings to enter into our system, and it drops down to 3.5 times EBITDA multiple. And that's exactly what happened when we acquired, for example, a Perfect Stay. We flagged in our announcement last week that gross booking values on an earn-out were to achieve circa $25.1 million next December 23. And with that, we certainly are within the range that I just spoke about, 4 to 4.5 times multiple of EBITDA. So we see a very strong and stable summer ahead. We also see it returning, as I said, to the habits of 2015 to 2019. To your point, to your question, Mark, are we going to see what has happened in the Northern Hemisphere right now? We've been out of the blocks, meaning out of lockdown longer than they have, which means that we've had the hike. And so therefore we're going to be just consistent, normalized bookings, which is good for us too, because as you can imagine, labor has been difficult over this time, attracting housekeepers and cleaners in general has been difficult and expensive. However, this is much more calm and much easier to deal with. Even though our ADR might be slightly 5 to 8% down, our bookings are around the same and are linked to, but we see that over time, and this is what happened in the past, meaning the habits of other times when there was depressed market, and I'm not saying this market is depressed, far from it, is that there will be more short stay booking, and that'll happen in the shoulder period and in the winter period.
And then we'll get one more in, I think, Will. You mentioned you're expanding into the adjacent services, the car hire, linen housekeeping. Are you in-housing these services, and does this introduce more capital and operating cost intensity into the business, or are the workers associated with these services more on a contract basis?
So firstly, I go to the workers. They're both employed and contracted into our business. However, that's number one. Go back to the beginning of your question, Mark. Yes, the ultimate objective is that we need to drive our core business. Our core business is making sure that we have a pillow for anyone that wants to sleep, be it in a hotel room, motel room, leisure park, a holiday home, or a villa, or a cabin. And it's really important. Here today, across the world, and here in Australia, in regional rural Australia, there's a shortage of linen. So we need to make sure that we've got linen, and it is of a quality and of a consistency to ensure it does not inhibit the use of the holiday home and inhibit the opportunity to book that home. So we've taken in key areas, and where there's scale with us, we've taken that into our own hands to make sure that we can drive the core of our business. And in doing so, yes, it drives revenue. Yes, it drives EBITDA, as I mentioned earlier, at a slightly tighter margin than we have with holidays and hotels. But overall, it's extremely accretive to our business. The other part about it is, believe it or not, we have built out our technology platform to ensure that it fits inside our platform and it drives further efficiencies for our greater platform and the people using it. And over the fullness of time, Mark, it'll prove to be very, very beneficial for driving consistency of service for our core, but also from a financial perspective.
Okay, thanks, Will. Listen, we're just up on time, and I know you are jumping on a plane to go to Magnetic Island. So thank you very much for joining us this morning and squeezing us in just before directly from the airport there. And we'll look forward to seeing the results in February.
God bless you, Mark, and thank you everybody for listening, and thanks for the opportunity, Mark. God bless.
Okay, thanks, Will. And if you could stop sharing your screen, please, as I know we do have Jim Bindon from Big River Industries with us, and John Lorente, CEO Designate. I should say Jim is CEO, soon to be handing over to John. If you, Jim, if you want to start sharing your screen.
Mark, hopefully you can hear me, mate. I thought you were going to do that for us at your end for a second presentation too, if you don't mind doing that.
I will. I'll get it up now. Here we go.
Yeah, great. Okay. So good morning, guys. You're just hearing from Jim Bindon first, and then I'll pass to John Lorente. As Mark said, slightly unusual circumstance where you're hearing from the current and the incoming CEO, but I think it's a real positive for the business. So so thanks for the opportunity, Mark. Might just move to that next slide if you don't mind, and I can give you a bit of an intro onto the business. But just before we do that, just on the appointment of the new CEO. So I've been in the business 22 years and 18 years as the CEO. So obviously in a public company environment, pretty useful that you don't stay on forever. So I think we went through a good process, and the board went through an extensive external and internal search process for the new CEO. So certainly pleasing from my point of view, and I'm sure from John's point of view as well, that ultimately the board chose an internal candidate, even though they did an extensive external search as well. I think that obviously it's a testament to John's performance and success in the business for the 5 years he's been here, but I think it's also sort of shows the board are very comfortable with the trading position of the business and indeed the strategy and culture of the organisation. So that's just a little bit of background on the CEO changeover, and John and I'll do a little bit of a tag team on this presentation if that's okay. So just quickly on the background of Big River, look, despite being a micro-cap company, it's been around for 120 years. So a long and proud history, and obviously a well-established business over many years. It's been listed since May of 2017, so coming up to 6 years after well over 100 years in the same family ownership. So the business is a vertically integrated manufacturer and distributor of a whole range of building materials. Now, the legacy of the business was in timber processing up in New South Wales, but that's expanded now to be certainly much more than timber, and to cover a whole wide range of building products that go into all segments of the construction industry. So obviously, part B of that spread of our business is a well-diversified supply chain, where we both manufacture products, we directly import from overseas factories, and then we have strong trading relationships with a range of local building material suppliers, both listed and unlisted. Our major focus is the big population centres on Australia, and John will expand on this when he showed you the mix of our business across the different construction sites. But in simple terms, the major population centres are where there's always going to be a strong blend of different construction types, and we think that diversity is the strength of the business across housing, renovations, multi-res, commercial, civil, and the industrial segment. So that sort of typically zones us in on the large population centres where you usually expect a blend of those types of construction. Good diverse product mix, as I touched on, going into all construction segments. So we've got very much a direct-to-market channel. So sort of think of us as the trade specialist, whereas Mitre 10 and Bunnings might be well regarded as where you might go to pick up retail products for construction projects. Think of us as the trade player in that space. So 10,000 active trade accounts across Australia and New Zealand, and a long successful history of acquisition. We've got a very fragmented industry and a bit of a textbook consolidation play going on. Big River's been very active in that, and it's certainly made our business stronger, more diversified, and aided by the strong legacies of several businesses that we've acquired. And the management team with circa 18 managers with good, strong direct shareholding. None of the managers were from the original founding family, so everyone has had to buy in when the family sold in the same way as any shareholder would. So I think we've got a really experienced team, but also strongly aligned people. So that's just a little bit of background, folks, with respect to the business. And then I'll just get John now to run through the next few slides, which gives you a bit of a feel for the mix of our business, and then a couple of the strategies in the key divisions of the company. So over to you, John.
Right, thanks, Jim. Good morning, all, and thank you, Mark, for the opportunity to present. Look, I'm pretty excited to take on the role and follow on the great work Jim has done. As Jim said, I've been here 5 years, so I do have a pretty good understanding of the business. So we'll just go through some of the key business metrics. So our supply chain, we've got quite a diversified supply chain, with 25% of our revenue being manufactured by our business, and I'll go through that in a second. 25% directly imported by our business, and 50% sourced from large local suppliers. It's great in terms of risk management. It's also part of the reason we were able to deliver such strong results over COVID, when others couldn't get stock, couldn't get products through their supply chains. Just going down one to the manufacturing sites. We just mentioned the manufacturing sites. We've got 6 manufacturing sites. We've got a plywood manufacturing site in Grafton. We've got 3 steel rolling lines, 2 in Grafton and 1 in Melbourne. We've got 3 panel manufacturing sites, and we've got 4 frame and truss now, with Epping Timber coming on board in the last month, making that 4, and 1 prefab bridge manufacturing site again in Grafton. Now I'll go through the sites around the country, but we've got 26 sites, as Jim mentioned, the major population centres, focusing on trade customers, servicing trade customers. 630 staff, with the average length of service of 10 years. So very experienced team, very knowledgeable. The autonomy and flexibility on the ground is key to our offer, and that experience is key to our business. And in terms of being split, we're quite diversified around the market segments. The detached housing, as you've seen the last few years, has grown significantly. But we're pretty strong in the detached housing. The multi-res has come down over the last few years, but it looks like that'll grow. The A&A, commercial, civil's now growing significantly, and OEM's been a good solid part to our business as well. So if we go to the next slide. Yep, that's the one. So look, Jim mentioned about focusing our dots on the map on the major population centres. We've got six sites, and the colour coding there, the building trade centres, formwork and commercial and panel businesses. We've got 6 sites in Queensland, 6 in New South Wales now, 2 in the ACT, 6 in Victoria, with Epping coming on board, a couple in South Australia, a couple in WA, and a couple in New Zealand. From the dots there, you can see that we're still pretty strongly working on our acquisition strategy, and there's some clear gaps where we'd like to grow in the building trade centres, particularly in Sydney and Melbourne. And we've just, as I mentioned, we've just acquired Epping in Epping Timber in Melbourne. The formwork and commercial, we've got some gaps there in Adelaide and New Zealand, and the panels in Adelaide, WA, and possibly expanding in Queensland. So plenty of opportunity for growth. Next slide, please. Back the other way. Okay, I'll just quickly go over both the panels and then the construction division overview. We're very clear we've changed the structure about 12 months ago, really focusing our efforts on customer and market segment. So the panel business is about decorative products, structural products. It's a technical business, and there's some significant commodity products to go with that. So having that balance between the commodity products and high value key niche products. The markets, that resi housing, alterations and additions, that commercial, transport, engineering. So quite a wide market, and very strong with cabinet makers, particularly with the timberwood business we acquired a few years back, and joiners, fit out trades. We're selling through resellers and merchants. Transport authorities for the bridge deck, and OEMs, things like companies like furniture manufacturers, RVs and horse float manufacturers, and the like. Right, so I won't read through all those numbers, but you can see the revenue there. We want to continue to add quality businesses to the group. I think we've still got some potential, as I mentioned before, geographically and in terms of products, to add quality businesses to the group. Maximise our secondary channel sales, either through resellers or through the construction network, because we've got quite a few dots on the map, and things like plywood and panels are not just sold to those customers we said down the bottom there. They're also sold to general builders. We're working pretty hard to strengthen the architectural presence in Australia, with a new architectural specification team to grow the decorative part of the market. And leveraging the strengths of each of the acquired businesses. So we've got some really strong businesses now within our group that we've acquired, and they all bring their own strengths to the business, and then targeting some high value R&D manufactured products will give us extra volume and better profitability. Then going on to the construction division. So the construction division I've been running over the last 12 odd months since we changed the structure. Within the construction division, we've got 2 divisions: the building trade centres and the formwork and commercial. So the building trade centres is focused on that general building, that renovation, fit out. We've now got 4 frame and truss businesses, and then being the local trade supplier for the building industry. That resi space, that medium density, and that alterations and additions is sort of key. And the customers there. So there's 13 sites across the country, and then the formwork and commercial is really about concrete placement and big commercial jobs. So these are big sites. We generally won't have multiple sites in one city for formwork and commercial. We'll have big sites. I also work as distribution outlets for our other smaller sites, and heavy construction, bulk products, that commercial, that multi-res, that civil space, which is now starting to come to grow across the country as resi is coming off a bit. So we see that formwork and commercial being a really important part to our business, and formworkers and civil companies and concreters and the like other types of companies. So our view in this division is that there is a lot of opportunity to continue to consolidate that fragmented industry, particularly with the building trade centres, and expand across the country. And the building trade centre business could definitely be double the size it is now in terms of revenue, and the number of sites. The strength in our local knowledge, that experience on the ground, that autonomy and flexibility is key to our customers. They love the fact that we work with them in the construction projects, leveraging key suppliers. So as we've grown, we've been able to leverage key suppliers. I think there's more opportunity to do that and get better synergies across the group and get deeper with customers and sell a broader range of products to our key customers is key as well. So we'll go to the next slide, and Jim, I'll pass it back to you.
Yeah, guys. Okay, so quickly, just some of the high-level financial metrics of the business. So you can see sales revenue growing strongly there over the last 3 years, up to 410 million last year, and certainly well on track to be well above 450 million in FY23. Obviously, strong growth in underlying EBITDA as well. Last year we had around 80% organic growth plus the contribution from acquisition. So there was certainly a blend of in-house and obviously newly acquired businesses that drove that EBITDA up to 48 million from 22.5 the previous year. Underlying net PAT also particularly healthy there at up over 21 million last year. So obviously some strong growth, not only as we've got past some of the headwinds of 2018 and 19 as the cycle was, as the construction industry was cycling down, but obviously some of the good work we've done on improving our supply chain and then acquisition contributions driven a lot of that growth. Obviously earnings per share down the bottom left has grown substantially accordingly. Cash conversion's been strong and has been consistent, averaged about 92% across those 3 years. A couple of peers of ours probably struggled last year in particular when inventory levels grew a lot, when supply chains were disrupted and everyone had to try and find product wherever they could and probably overdid it, to be honest. I think we've managed that particularly well and had solid cash conversion in our usual range. And gearing obviously trending down over the last 3 years to be about 16% in the year just gone. So I think strong balance sheet capacity. Obviously dividends has grown very substantially. It's not on that slide, but last year we paid, if you took the average share price for the year, it was close to a 10% grossed up yield, including the franking credits. Obviously the company's got a lot of franking credits from being a profitable business over 100 years. So that's something a touch unusual for microcap to be paying really strong dividends and fundamentally growing and having a very strong growth path in front of us given the consolidating industry structure. So I think we're a little bit of a quirky long-term business that still sits in the microcap range that is growing rapidly and is also paying a very healthy dividend. So I think from a financial perspective, I think there's some really strong metrics there. Return on equity, just a click under 20%. In my view, that's they're particularly solid numbers. So I think the financial performance speaks for itself, which is pleasing. And just moving on to the next slide, Mark. So just a quick summary from my end, and then I'll just get John to run through just in the last couple of minutes some of the some images of the projects we deal with to help set the context of where our business sits. But just on a summary point of view, look, it is obviously a durable and sustainable and long-term proud business. That's still the way we operate. We've been listed for only 4% of our life. The other 96% we've been in a family environment. So I think we've got the best of both worlds. We've got an extremely entrepreneurial culture, but we've obviously, being in a public environment, we've had to improve professionalism and we've got access to capital. Earnings has grown strongly as per that previous slide. Just a dot point there that, there was a strong trading update at the AGM in October. So continued that strong growth that we saw in FY22. So earnings and revenue have grown strongly in Q1. Obviously all that data's there in the AGM update, but revenue was up 33% in Q1 versus the prior period and underlying EBITDA up 62%. was helped by a couple of acquisitions that weren't there in the comparison period last year, but strong organic growth as well. So as I touched on, a really large and fragmented industry, so great opportunities to consolidate. There's not any really strong, active, dominant players consolidating the space. So in our view, Big River's got as strong a chance as anyone to continue that. Lots of businesses facing succession issues. We get calls every second day from ageing business owners with really strong, well-regarded businesses in their local geography, but obviously there's not family succession plans there. And finally, from my point of view, a really great ESG story, not well understood, but in my view, the public's starting to learn more of it. But yeah, the carbon sequestration qualities of timber, and it's the lowest embodied energy building product by far. It's light years below the next best building product. So those attributes are certainly being well understood now. Some large high-profile buildings being built out of structural timber, including the new Atlassian building, which you may have heard of. I think globally and within Australia, the great qualities of timber as a building material are being more understood. And I think that sets the business up even stronger for the future. So that's a quick summary point. I might just get John to quickly run through a couple of slides before we start the Q&A to give you a little bit of feel for the mix of our business.
Great, thanks, Jim. So look, just a few images of the actual products and a few of the projects we've supplied over the last 12 months. So on the left-hand side there, Polaris is a product that we import out of Europe. Polaris black mat on the furniture, on the table, and then actually on the kitchen as well. So it's an anti-scratch, soft touch type of material. The armour cab, timber veneer panel there on the bottom left, an armour panel in the centre there. So that was a job in Redfern, renovation, a big renovation in Redfern of a couple of townhouses, a couple of Federation townhouses, and also using some of our form ply there. The black there is actually some innovative use of our form ply. On the right-hand side, on the top right is one of our bridge decks and girders that have been manufactured out of Grafton. So great opportunity to expand that further. We've done quite a few of these across New South Wales and Queensland. There's an opportunity in New Zealand and then across other states as well. There's a lot of timber bridges across country areas across Australia and New Zealand, and generally they're funded by the local government, and they can't afford to put big concrete bridges in. So rather than just replacing them with the old standard timber bridges that you see, these have a better lifespan and are cost effective for them. And some feature grade veneer black butt there on the bottom, another kitchen renovation. We go to the next slide. So in the formwork and commercial space, so on the left-hand side there, we both armour form and deck ply. So armour form we manufacture out of Grafton, locally made, and up to F27, so hardwood, and more niche, higher value product. And then the deck ply is what we import out of China for large formwork projects. And in the centre top there is a big deck in New Zealand, Auckland, New Zealand. The one on the bottom is the steel rolling line we talked about. So the steel decking, permanent formwork. That was for a Bunnings store. We've done quite a few Bunnings stores. The steel decking's used where there's an extremely large deck and they want to save time on the labour. On the top right, we're working with CSR. Jim mentioned it at the end of year presentation. Working with CSR with AFS Ready Wall and supplying that, again a concrete placement product and a growing segment of the market. And Red Edge, we saw an opportunity with edge board, particularly for slabs, for house slabs and the like. And we've started importing our own Red Edge LVL product into the market. It's been a good success as well. And last slide, the building trade center. So it's the sort of product that we supply. So decking there on the left-hand side in one of the jobs in Queensland. MaxiWall, we've had MaxiWall for a while. We acquired it. We acquired the brand from the Adelaide business that we acquired about 5 or 6 years ago. So that's AAC panels. and CSR are manufacturing that for us as well. On the bottom, some flooring. So our flooring business is growing. So we manufacture some flooring out of Grafton, and we also import some new generation flooring from the market, and also then have solid strip timber flooring. And then the two on the right-hand side, so the bottom one being a frame and truss job from Geelong, and obviously out of Beaufort, now Epping in Victoria, Epping Timber in Beaufort, and Dry Creek and Midland in WA. We've got an opportunity to expand the frame and truss. And then the top right-hand side, we've supplied several products in that project, and look, we can supply out of the building trade centres products for the slab, for the frame and truss, for the cladding, for the lock-up and the fit-out. And that's part of our focus across the building trade centres to get the whole of house offer.
All right, Mark, so back to you, mate, for a bit of Q&A, hey?
Yeah, we've had questions come flying in here. Let's just see here. Do the large local supply partners have any of their own in-house distribution, and what has been the trend in respect of this over time? So, like, you know, stuff that CSR is manufacturing for you guys, you know, how do they distribute that on their own, or is it, you know, primarily built specifically for Big River?
Yeah, and I can maybe answer that one. So really quickly, I know we're short of time. Look, our major supply partners in Australia, they all sell through a merchant channel. So they sell through companies like Big River and indeed Mitre 10 and Bunnings and so forth. So yeah, they don't have a direct to channel market. They don't sell direct to the contractors. And the reason they partner with companies like us is we have the spread of sites on the ground, you know, distribution centres around Australia, sales staff on the ground, and indeed selling a whole range of products that we can bundle up for the end contractor. So that's pretty much the supply chain. And in the main, most of the local players, it's a fairly commoditized product range, so we don't have exclusive supply. But that's obviously, yeah, but that's a positive as well, because there's multiple suppliers in each product. Yeah, that's pretty much supplied. So hopefully that sort of covers that particular question around the channel strategy of our major supply partners.
Okay, and then the next one then on the expansion, how many further sites around ANZ can you expand to over the medium term from the 23 today? And is this going to be organic, you know, greenfields, building your own, you know, trade and building centre, for example, or, you know, you referenced the phone calls you're getting, you know, small bolt-ons of a localized player, you know, in a geography that, you know, it makes sense for Big River.
Yeah, John, do you want to tackle that one, mate?
Yeah, so Jim's already presented to the market and said, look, our target's between 2 and 3 acquisitions a year. I talked about the major sort of geographical areas for each of the 3 divisions where we've got gaps. At any one stage, we've probably got 10 to 20 potentials, and obviously all those don't come through, but there's plenty of opportunities for us to grow and in my view be able to double the number of dots on the map. But obviously they have to make sense strategically and for our business in terms of 3 segments and then or 3 divisions, and then also makes sense geographically. But 2 to 3 years probably the answer in terms of what we're looking to do, and we've got plenty of headroom to be able to do that.
Another one then, can you talk about the gross margin differences between the different end customers, you know, resi versus commercial versus, you know, the formwork end customers?
Yeah, maybe the best way to cover that is to talk about the 3 divisions. So the gross margin is the highest in the panels division because it is obviously the most differentiated. A lot of the products are differentiated, I should say. And the trade centres and the formwork and commercial are very similar. So there are probably only about 4 to 5 percentage points behind the panels division. You see our overall gross margin last year was around 27%, just in the low 30s in panels and in the mid 20s in the trade centres and formwork and commercial. So there's not a huge variance, a huge difference. Obviously, in the commodity type products, in the trade centres and in the formwork side, you get higher stock turns, so certainly better asset velocity, but slightly lower gross margin. Whereas in the panel side, where there's some key differentiated products, particularly coming from Europe, you've got to hold a little bit more stock. You get the higher gross margins, which is what you'd expect.
And then a question on gearing. It's been trending down as the slide noted. Are you trying to get it to zero, or have a particular figure in mind, or what's a kind of comfortable gearing level that you're working towards?
Yeah, no, we certainly don't want to get to zero. We're not having a go if we let that happen. Obviously, we've got a 50-year relationship with the NAB, so they know our business well. We've got a good facility there, so we want to utilise that debt capacity. We've got to continue to rationalise the industry and expand our business. So obviously, part of the reason that our dividend was so healthy last year, and that's been paid in October, is because of that strong cash position and that strong balance sheet position. So the shareholders were rewarded accordingly for that, but as well as that, our intention is to use that. We're very comfortable up to 30% gearing, and we've been beyond that in years gone past. So plenty of headroom there with the bank to continue to utilise that debt facility to expand the business.
And then one on supply chains. I mean, you just mentioned Europe a second ago. Supply chains, are they continuing to normalise? Cost of getting it to Australia, and lead times, such that you can kind of start to bring stock back to kind of 2019 levels, and lead times trending towards 2019 levels.
Yeah, John, you can tackle that. I think whoever asked that question absolutely knows what's going on in the industry, John.
Yeah, so look, absolutely, it's getting better, and whether it's to 2019 levels, I suppose I couldn't say, but it's definitely getting better. Particularly out of Asia, and Europe is improving as well. I think the difficulties in terms of supply of late has been around more so around labour in Australia, but the fact that we have several supply chains or supply from different suppliers, both internationally and locally, for the same products, to put us in a pretty good position.
Okay, and this probably waxes and wanes from year to year, but how much of the business in any year would be exposed to new construction versus repair, renovation versus infrastructure?
Yeah, you probably see that from one of those slides there. So the renovation market's circa 10% of our revenue. So most of it is obviously about new build. And then part B, that question, infrastructure, civil, sort of ranges between 7 and 10% of revenue. Obviously, as the infrastructure segment is stronger, then that'll weight up. And then particularly if some of the other segments get a fraction softer, then that civil and infrastructure will weight up. So in simple terms, about 10% civil and 10% in the renovation market, and the rest is across housing, multi-res and commercial construction, and indeed industrial supply as well.
Okay. Jim, John, I think we'll leave it there because we're just bang on time as we finish up here. So Jim, thanks very much for coming back and joining us again, and wish you well whatever comes next. And John, hopefully we can get you back in 2023 once we've got a few more announcements and a few more results under your belt.
Fantastic, thank you.
Yeah, great. Thanks, Mark, for your time.
Okay, thanks, Jim. Thanks, John. And I do know we we'll leave Grafton and head to Chris Noone. Chris, if you want to start sharing your screen, I'll let you know when I can see it coming through.
How about that?
It's coming through now. And yeah, if you just want to go to full screen mode or start the slideshow just so we get it. Yep, perfect.
Okay, well, good morning, everyone, and thank you, Mark, for the opportunity. I'm Chris Noone, CEO of Carly Holdings, and we operate Carly Car Subscription. To give you a bit of background on the business, we are Australia's first flexible car subscription service, and we launched it in March 2019. Subscription is a monthly recurring payment for a vehicle, which is all inclusive, and it's an alternative to financing, purchasing, or leasing a vehicle. Since we've launched car subscription, we've brought on some major shareholders into the business, including SG Fleet and also Turners Automotive. And we're the only ASX listed company focusing on the car subscription opportunity. Our research that we've commissioned shows that 38% of Australians would consider car subscription, and that increases to 69% of Gen Z and 50% of millennials. We're really at the very start of car subscription industry, so those numbers can only start to grow. Just trying to get on to the next slide. There we go. So we've moved into the car subscription industry, not as a new business. We've actually had 10 years of experience in an adjacent industry, in the peer-to-peer car rental industry. So this was a very effective and qualified pivot for us. We've also got a lot of experience in the automotive industry, having over the last few years, bringing in directors and also management from some of the largest players in the automotive industry. During COVID, we've actually been able to prove our business model. We've had challenges both on the supply and the demand side, and we've actually come out of that in a much stronger position. One of the key changes we've made is that we've transitioned from a predominantly asset-light fleet, and that's where we don't own the vehicles, to more of an asset-heavy fleet where we do actually own the vehicles, and I'll talk through the advantages of that approach. We've also been experiencing very strong growth. In the last quarter, we reported 27% increase in receipts from customers, but interestingly, the revenue increased at 108%, and that's because we're changing the mix of vehicles and the way that we are building our fleet of vehicles, and I'll talk through why that is important and why those figures will continue to increase as well. So just going back to the fundamentals, what is a car subscription? It's a fast, flexible, low-risk way for individuals and businesses to get a car for 30 days or more. It's a simple monthly payment that includes registration, insurance, maintenance, and roadside assistance. It's your car to use exclusively. Park it in your driveway, park it in the car park at work. There are no break fees or upfront deposits. It's a minimum 30-day term and 30 days notice to cancel. You can also switch the car during the period. If you need a larger vehicle when family are visiting, you want a convertible for summer, you can switch into that vehicle. Most importantly, it's not a long-term financial commitment or debt. So the best way to describe car subscription is to show where it positions relative to other solutions. Right at the short period, you've got car share. These are companies like GoGet, Car Next Door, typically 1 hour to 1 day, very suitable for that purpose, but very expensive when you go into multi-days. Then you have car rental, a very traditional business, very wide price fluctuations, especially coming into the holiday periods. And the average periods are around 7 to 14 days. Car subscription sits above car rental. It is a much cheaper option. It is a more reliable option, having consistent prices throughout the year. And the average subscription period that we report is 5.6 months. So it's definitely not a car rental solution. And then in the longer term, you have outright purchase and finance of vehicles, which is 2 to 3 years plus. So what we've established with car subscription is a very solid, well understood niche between car rental and the longer term financial commitments. We're very privileged to have some very large shareholders that have invested in the business as soon as we moved into the car subscription opportunity. And also we're fortunate that those CEOs of those companies sit on our board. So we have Robbie Blau, who's the CEO of SG Fleet, one of the largest fleet management and leasing companies. We also have Todd Hunter, who's the CEO of Turners Automotive. Turners Automotive is the biggest seller of cars in New Zealand. Also recently, Mike Mobilia has joined the business as Chief Financial Officer. Mike has a very strong background in asset finance, and a very large part of our strategy going forward is to secure asset finance to quickly grow our vehicle fleet, and that's been a very crucial hire for us. So to talk about where Carly fits, we're a marketplace. We sit in between the vehicle supply, the fleets of vehicles, and also the customer demand. We do the marketing, we provide the website, the insurance, we do all the ID verification to make sure that we're getting good quality customers into the marketplace. We do the sales work, we manage the fleet, we collect the payments, and we do all the data analysis. Now, on the supply side, traditionally, we've had a completely asset-light fleet. This is where we didn't own the vehicles, and we paid a monthly fee to use those vehicles to the owners. Now, the owners of those vehicles could be automotive manufacturers. Examples of companies we've worked with: Subaru, Peugeot, LDV, who've given us hundreds of brand new cars to provide as a rental or subscription product through our business. We also work with a range of automotive dealers who provide both new and used vehicles into our fleet. They're looking for an alternative revenue stream. Also, fleet management companies. We've worked with pretty much all the major leasing and fleet management companies who provide vehicles for us at usually end of lease. So if those vehicles have been on lease for 2 or 3 years and they still have a usable life, they'll put them into our fleet to further monetize those vehicles. We can also secure vehicles from corporate fleets and strategic partners as well. What we've changed more recently is we've introduced an owned fleet, and the owned fleet now makes the majority of our overall fleet. And depending on the economics, we either purchase, lease, or finance those vehicles. On the demand side, we work predominantly in the consumer market, and there are a range of different demographics for which car subscription is suitable. The key thing is that car subscription is flexible. It gives people and businesses the opportunity to secure the car that they need, but they don't need to make the long-term financial commitment. And quite often people are seeking a car, but it's not the right time for them to buy or finance a vehicle. And we don't see ourselves replacing financing or purchasing a car. We're just a better solution for people and businesses at certain points of their journey. Also, we've got a strong opportunity in the business market as well, and that's one of the reasons that SG Fleet invested in our business. So we've been growing quite substantially all the way through COVID. Our legacy existing business at the start of COVID, we were in the rental market. We saw car rental, rideshare rental revenues plummet as they did for all other competitors at the start of COVID. But what we saw was that subscription kept on growing. And even in the latest quarter, we saw 108% growth compared to the previous year. And importantly, the subscription revenue as a percentage of subscription transaction value has increased from 33% to 51%. So this graph here shows the improvement. Our transaction value has been increasing. Now, what's been happening here is that we've been retiring some of our asset-light vehicles and at the same time replacing those with asset-heavy vehicles. So the overall transaction value hasn't increased that much because our fleet size has been relatively stable. We've now passed that tipping point where the new additions of asset-heavy vehicles are starting to grow the overall fleet. So we'll start to see further growth in transaction value. But what's been happening underneath that is that subscription revenue has been increasing in quantum, but also as a proportion of subscription transaction value. And that's because when we own the vehicles, we retain a higher proportion of the transaction value. So that's really important for us going forward, and it will mean that we're a profitable business much sooner. What we've also been doing is achieving very good results in online customer acquisition and driving down the cost of that acquisition. We found when we were in the rental business, it was a very competitive market, very difficult to acquire customers at low cost. In the subscription market, we've found ourselves a good niche where we can be a big player in that market and drive very good economies of scale. We've also got very good search engine optimization, which delivers free traffic and free customers to us as well. You can see from these figures, looking at the June quarter year on year, we've been growing the transaction value by 16%. The subscription revenue has grown by 70%, and that's because we've been upselling customers to higher value plans, but also because of the change in the fleet mix, moving from the asset light to the asset heavy vehicles, and that's flowed through to the gross profit as well. And these figures will continue to increase as we introduce more and more asset heavy vehicles into the fleet, and also introduce general price increases as well. Our lifetime value metrics have also grown quite substantially. So our retention period at the moment is around 5.6 months. Our transaction value has increased by 14%. The subscription revenues increased by 68%, and the gross profit has increased by 40%. So we acquire a customer, we're driving down the acquisition cost of that customer, we retain them for around about 5.6 months, and each of those customers is delivering around $1,800 in gross profit. So we have a number of competitive advantages compared to direct competitors and also other players in the industry. We're coming into this new market with some very good adjacent industry experience. We've got some strong industry partnerships. I've mentioned SG Fleet and Turners Automotive. We also provide subscription services for Hyundai. We're an online business. We can scale across the country very easily. As soon as we have a supply of vehicles in a certain area, we can be operational in that area. We do not have a strong investment in bricks and mortar. We invest in technology to scale. We're a mass market proposition, very easy to understand our proposition. When we've been featured on Channel 7, Today Show, Sunrise, talking about car subscription, we get immediate spikes in our web traffic, and that says to us that people really understand the subscription opportunity and are immediately interested in it. We own our own technology platform, which means we can innovate and scale according to our own strategy. We don't fear any regulation in this business. We're a no deposit, no long-term financial commitment product. A number of years ago, the banks and finance companies received a lot of attention from ASIC and other regulatory bodies about locking customers into long-term debt. We are the alternative to that and a much safer option for people. If circumstances change and the customer can no longer afford the vehicle, they simply give 30 days notice and hand the vehicle back. We have diversified revenue streams. We have direct income from customers. We have referral relationships, and we also have licensing income from Turners Automotive in New Zealand, where we provide the technology platform for them to run their own subscription business. We work directly with the industry as an enabler. We're not a competitor. We're not a competitor with the manufacturers, the dealers, or other leasing companies. We can provide many advantages to them and help them introduce new revenue streams. And we've got a hybrid approach to supply. We have the asset light fleet and also the asset heavy fleet as well. And we will continue to emphasize and de-emphasize those segments according to the market conditions. We also own our own verification platform, which allows us to convert customers very quickly in an online method, but also we verify those customers to, we only want good customers who will keep paying the subscription fee, who will look after the vehicle and return it in good condition. We're very happy to turn customers away if they do not pass our verification checks. And we've also secured an ATO product ruling, which confirms the tax deductibility and fringe benefits tax treatment for our product. And we're the only company that is car subscription company that has got the product ruling. So any other car subscription company cannot rely on the same product ruling, is exclusive to Carly. So we have a number of growth opportunities in FY23. We will continue to improve our conversion and acquisition costs. We're securing supply of vehicles. Yes, there are long delays in delivery of vehicles in Australia, but we've reached a good cadence of placing forward orders to vehicles, and we're getting good growth in our fleet. We have many opportunities to expand into the business and government area. We're doing that already with SG Fleet. There's still a lot more opportunity in that relationship, and there is no restriction on us working with any other party in Australia as well. Subscription can also be a great transition to electric and hydrogen vehicles. It's a great try before you buy opportunity. A number of individuals and businesses want to get into electric vehicles, but they balk at spending $60,000, $70,000, $80,000 on a vehicle, and they don't know if it's going to suit their needs. So subscription is a great way to try it in real life situations and understand the type of vehicle or whether the company or individuals are ready to move to electric vehicles. We've commissioned research through Omnipol, and what that has determined is that 38% of Australians would consider car subscription. That increases to 47% of people with children, going up to 69% of Gen Z and 50% of millennials. So we know that there is strong demand for car subscription. We would have grown a whole lot more in the last few years if we could get access to the supply of cars. Now we've actually sorted the supply of cars. We are securing asset finance. We are receiving deliveries of vehicles. So we're on the verge of accessing the potential that our research shows. Research from around the world also shows that car subscription, is a very big opportunity. And, in the next few years, we see it being a substantial part of the new car and used car market. I mentioned before that we have transitioned our fleet. We now have a hybrid model, asset light and asset heavy. We are still continuing to secure asset light vehicles, but because of the supply restrictions and the high cost of used cars, that's not our major focus. Our major focus now is on the asset heavy model, where securing asset finance and placing orders with dealers is the fastest and most reliable way for us to grow our fleet. So asset finance is a big opportunity for us. We've been successful in securing finance over the last 12 months or so, and we expect to make some announcements very shortly about further finance that we've secured, which will allow us to directly increase the size of our fleet. This table here, I won't spend too much time on this, but this is available in our investor presentation, but we show the difference between the profitability and the revenue from an asset light, a leased and finance vehicle. So if you look at the bottom row there, a leased vehicle, a vehicle that we are leasing and providing to a subscription customer, delivers 25% more gross profit compared to an asset light, and that increases to 68% more for a finance vehicle. So a finance vehicle, yes, we have debt on our balance sheet, but that's more than compensated for by the extra revenue that we receive for that vehicle. We have a number of key partnerships across the business. A lot of big companies trust us to either manage their vehicles or they refer customers to us. And we, in many ways, are an innovation lab for these companies looking to move into different mobility solutions. Just finishing off here, going into our relationship with SG Fleet, very strong relationship. SG Fleet provide asset light vehicles to us where they retain the ownership. They also lease vehicles to us on an asset-heavy model, and they also refer their government, not-for-profit and corporate customers to us when they need a vehicle for less than 2 or 3 years. We also have a very strong relationship with Turners Automotive in New Zealand. Turners subscription is growing very rapidly and has a very large proportion of electric vehicles in that fleet. Carly provides the technology platform for that business, and it's a great learning opportunity for us to learn of what's happening in the New Zealand market, which unfortunately is ahead of us in the electric vehicle transition, but once again, a great opportunity. So there'll probably be some questions. So I'll move through into the final slide and pass back to you, Mark.
Thanks, Chris. First question, this change in mix of, from asset light to owned vehicles, how much longer do you anticipate that to take? Is it 6 to 12 months, 12 to 24 months? And, is the end goal to get to 100% owned, or will there always be some kind of mix between, vehicles on lease from, say, SG Fleet or Turners, with, maybe the largest proportion being your own fleet that is the asset finance back fleet?
We always expect to have a balance between asset light and asset heavy. At the moment, asset light is not that attractive because there's not an excess of cars in the market. So that's where we're favouring asset heavy. We expect that there will still be restrictions on supply of vehicles going into 2023. But most recently, we've seen reports that microchip shortages are pretty much over. The shipping costs are coming down, shipping delays are reducing. So we're expecting more vehicles to become freely available in the Australian market. So that means that when we are financing or purchasing vehicles, we'll be able to receive delivery quicker, but also manufacturers and dealers and also leasing companies will be looking to us to monetize their vehicles through an asset light approach. So when we choose a vehicle on asset light or asset heavy, we don't need to make a big strategic shift. We operate both models side by side. So it's very easy for us to take on an asset light fleet. So for instance, we just signed up a new automotive dealer last month. They've already got over 15 cars for us, and that took us a day to bring those vehicles onto the platform. We'll also receive deliveries of vehicles on an asset heavy basis from a dealer next week, and they'll be on the platform in a day as well. So we're agnostic as wherever we can get the supply that makes economic sense, we will take that supply, because we're running at 87% utilization, and we have more demand than supply at the moment. So we will take on every bit of supply we can get.
We have a question there. What are your plans to scale up, and when will you be in a position to have vehicles to offer? So I think somebody obviously trying to sign up but couldn't get a car.
Unfortunately, we are turning customers away, and we're working as quickly as we can to bring as many vehicles onto the fleet as possible. In our major areas of operation are Sydney, Melbourne, Brisbane, and the Central Coast of Sydney. We've always got cars available, but they may not be the exact type of car that a customer is looking for. It might be a different price range, they might be looking for a small car. We may have an SUV. But we're constantly receiving deliveries of vehicles, and also vehicles are coming back. Once people sort of reach that 5.6 month average period, vehicles return and they're available for other customers as well. So a big focus for us is maintaining 87% utilization or more. But definitely we are growing the fleet, and the larger the fleet will mean that we're turning away fewer customers.
You mentioned marketing costs trending down. We've got a question: why is the cost to acquire a customer when you compare it versus the revenue from a customer over that 5.5 odd months?
We're becoming better at what we do. We really understand the subscription market and we're focusing on it very intently. Some of the other players in the market are doing car rental, car share, leasing, other things as well. All we're doing is car subscription. And we're also a 100% online business. So we've done a lot of work on search engine optimization, which means that the organic results that you don't pay for on Google, people are clicking on us, coming through to us at no cost. We also have referral relationships as well, where we do pay a small fee to those referral partners, but that fee compares quite favorably to an online acquisition cost. So, there are a lot of things that we are doing to drive down that customer acquisition cost, but a lot of it has to do because we are 100% focused on this car subscription opportunity.
And 5.6 months, the kind of average subscription time. Can you just give us a sense, how that has trended over time? Is it, trending upwards, downwards, or has that kind of remained, pretty constant since you started the business?
We measure it on a 12-month cohort basis. So it's actually a very accurate measure. The number hasn't been moving much. We're actually a little bit higher a few quarters ago, 5.7 months, 5.6 months now. In the last sort of 6 to 12 months, we've actually been retiring quite a few vehicles from our asset light fleet. And for some of those customers, we didn't have another vehicle for them to move into. And we retire those vehicles because they reach their kilometre thresholds where the owner wants the vehicle back or it's no longer suitable for subscription. We've now moved past that tipping point where we are actually having net additions to our fleet. So we're not terminating any customers. So we expect that 5.6 months now will start to grow. But because we measure it on a 12-month basis, which is the most accurate way to do it, it will take a while to actually show. But we are seeing that our 3, 6, and 9-month cohorts, we're starting to see increases in those average retention periods.
And then one final one, we'll just try and squeeze it in, Chris, if we can. Why would the government use Karafili and not just Eclipse or SG Fleet directly, as they can provide pretty much the same service?
I wouldn't agree with that. Some leasing companies provide a mini lease service. Most of them don't. For a leasing company to provide a vehicle on a short term, it's a very, very different market for them. Usually when they're leasing a vehicle, it's locked away for 3 or 4 years. They know that the vehicle will be fully utilised at 100% for 3 or 4 years. They know that the business or government department will be paying for that for the entire period of time. What we offer is the opportunity for that entity to take a car for 30 days and then give us 30 days notice when to turn it back. That's not the way these large companies operate. It's not the way their finance is set up. It's not the way their handover facilities are set up. So, this is one of the main reasons why SG Fleet invested in us, because we can do this shorter term opportunity much more efficiently, because it is what we do every single day.
Okay, Chris, we're going to leave it there. But before we do leave it there, I just want to call out that RAS research have just initiated on Karafili, and I've put the RAS note. It's in the chat for anybody who might want to download it, and for the YouTube people, feel free to go to the RAS website and you will be able to download it from there. Chris, thanks very much for coming in and giving us the Karafili story 101. It was great to hear it firsthand.
Thanks very much for the opportunity.
And if you could please stop sharing your screen, because I do know Andrew Booth, CEO of Advanced Braking, has joined us from Perth. Andrew, if you want to start sharing yours. Yeah, it's coming through now. Yeah, and if you just want to go to slideshow mode or full screen, there we go. Perfect. You're good to go, Andrew. Just take.
Good morning, everyone. And I'm I'm delighted to be presenting to you Advanced Braking Technologies Investor Update. My name is Andrew Booth, and I'm the CEO of ABT. ABV is our ticker for ASX. So for those of you that are less familiar with ABT, we are a braking solutions original equipment manufacturer. Our ethos is all about safety, protecting people, assets, and the environment. We've got two brands, Failsafe and Failsafe Emergency. We design, develop, test, and manufacture braking systems all in Australia. We have over 20 years of experience in our intellectual property, which is essentially sealed wet braking technology. We make heavy-duty brake solutions for mining, defence, waste management, civil construction industries, and we're more and more diversifying our products into other customers and industry sectors. We are focused heavily on innovation. We have an ongoing R&D program. Safety and environmental responsibility are part of our mission. And we're all about reducing our customers' downtime costs and increasing the operational efficiencies for fleets and vehicles in heavy industrial settings. I'll talk a bit about that in the next few slides. As I said, safety comes absolutely first in everything that we do. We provide our customers with a zero-emission brake, and I'll talk about how that works. We are committed to ongoing innovation, and we've had some really exciting developments over the last couple of months with a key customer. We export to over 40 countries, and our export markets are growing. In particular, North America, South America, and Africa are very key markets for us, and I'll explain why that is. So this is our team. We are a small and agile team. I've got about 15 years of strategic experience in both Australia and in Asia, working in both mid-cap corporates and multinational companies. I've had experience in terms of organizational culture, turnarounds. Business development is my key focus. Angela Godbia is our CFO. She comes from Orbital, brings a really strong experience in terms of ASX listed manufacturing environments. And David Newcomb, our head of engineering, is ex-General Motors and brings that really important international automotive OEM experience to our team. Our Q1 results are strong. We're sustaining double-digit revenue growth. And we are in positive ongoing operational cash flow. We're really focusing this year on deepening our really valuable blue chip customer relationships, and I'll show you what that looks like. As I said, we're growing our export sales and international partners on the ground in our key markets. And we're importantly really focusing on strengthening our foundation capabilities to support scale for this business. And you'll see where those scale opportunities are coming from shortly. We've had a really strong supply chain strategy, which has increased, I guess, the engagement with our very important supply partners. And we're focusing on integration of that supply chain in an ongoing way. New product development is absolutely at the forefront of what we're working on at the moment, and that is providing us with the opportunity for revenue diversification as well as scale. Our EBITDA is positively trending, and so this is Q1 FY23 results. We've delivered a product sales margin of over 50%. It's up 12.9% on prior comparable period, and our net profit is substantially higher, delivering $450,000 up 814% on prior comparable period. Our operating sales are $3 million, up 12.6%. We've got a strong cash balance. We have no debt. So we're in a strong financial position to grow the business in a balanced way, both organically and inorganically. You can see here the orange bars represent that quarter one results year on year, and you can see that we've just delivered a record quarter one off the back of a record quarter four, and when we're still we're looking strong ongoing. Our customers are this is a bit of a brag sheet for our blue chip customer base. We've got very strong relationships and loyal relationships with tier one mining companies here in Australia, and more following these companies offshore into developing markets, both mining and mining services. We've got very good brand presence for as you know, ABT and Failsafe are the synonymous brands in Australia and more offshore in terms of providing a fail-safe brake for road vehicles that are ruggedized for underground mining. This is our product. So on the left-hand side, you've got a wheel end, 100% sealed wet disc brake for light commercial vehicles. And that has, of course, the fail-safe capability. And when I say fail-safe, it prevents unintended vehicle movements and is designed around people using these vehicles on steep inclines, jumping in and out of these vehicles on a regular basis to open boom gates, to do point checks. You release the seatbelt, the fail-safe brake comes on, you open the driver's door, the fail-safe brake engages. It's air over hydraulic, which means similar to a truck brake, it's energy off, brake on, energy on, brake off. So if you like, it's when all else fails, the brake engages. Very important safety solution for high-risk environments such as underground and above ground mining environments. On the right-hand side, we have a driveline brake. This is a truck product. So we have small, medium, and large size brake systems. It's exactly the same design concept as the wheel end brake. It's 100% sealed wet disc brake. However, in this instance, it's mounted to the driveline of the vehicle and essentially provides an emergency fail-safe brake. So it's not actually part of the service brake. It's simply a handbrake and an emergency brake. Exactly the same concept as the left-hand side. So what problems are we solving for with our customers? We're solving for open brake systems that suffer damage as a result of harsh off-road environments. Abrasion and corrosion and contamination renders these brakes redundant and in need of service every few weeks, typically. And so our 100% sealed brake system protects all the internal brake system from that external environment. We prevent unintended vehicle movements and the risk associated with vehicles moving in underground environments. Essentially, it's a fatal, potentially fatal, situation, and we prevent that. We were also preventing harmful brake dust emissions in enclosed environments where air quality is absolutely critical, and I'll talk a bit about that in the next couple of slides. Underground mining is core to our market, our target market. Global underground mining is anticipated to grow in double digits over the next 7 years. That's been driven by rapid industrialization of the developing world, as well as the very strong demand for technology and batteries. So battery demand is driving very heavy forecasts for rare earths and battery minerals, closely associated with hard rock mining and gold. And we're seeing increasing investment by mining companies around the world for deeper and more expansive underground mining as a result of that. I recently attended IMARC and will be exhibiting at IMARC next year. So please come and see us on the IMARC stand. Fantastic event. Basically, it really highlighted a couple of aspects of technology, and that is that, you know, EV and autonomous, connected, and artificial intelligence is absolutely at the forefront of this sector at the moment, as well as environmental, social, and governance trends. It's a really dominating issue for mining companies at the moment, and they are investing and have very strong appetite for solutioning for these matters. You can see here a typical vehicle that we install brakes on, front and rear brakes, 100% sealed. So we remove the actual brake architecture of the wheel end and replace them with our sealed disc brake system. You can see here also, it just highlights you know, that the brake is on the wheel end, but there's a fully integrated computer system and a control box that sits on the dashboard that provides the operator with that big red button, and that is their emergency fail-safe button. However, operators also use that essentially because it becomes the handbrake. As I said before, you release the seatbelt, you open the driver's door, the brake engages if it has not been operated prior to that. So it is a fail-safe. When all else fails, that brake engages. In terms of emissions, so 50% of a vehicle's emissions is exhaust. The next contributor to vehicle emissions is brake dust particulates. They're extremely harmful to human lungs. And as fleets move more and more to electrification, brake dust emissions will be the largest contributor to a vehicle's emissions moving forward. Very important. Mining companies around the world spend hundreds and millions of dollars on air purification for underground mining. Any way that they can control emissions of vehicles, and they're often diesel vehicles, heavy equipment, really big emitters, air purification and air quality is critical. ABT has recently signed a really important and milestone product development agreement with our customer, Glencore. It's a sealed brake system on a wheel end. It's a wheel end design for a Volvo FMX truck. Glencore has been experiencing vehicle movement at one of their mines at Vulcan in South America. And as a result, they've also had considerable downtime in terms of having to continually bring these vehicles offline and strip the brakes on a weekly and fortnightly basis. The OPEX advantages on this vehicle are significant versus the yellow goods equivalents. They're about a third of the cost. However, the capex advantage on these vehicles is significant. The OPEX is creeping on this fleet strategy for Glencore because these vehicles are needing to have their brakes serviced on a too regular basis. So Glencore approached us 12 months ago, knowing our SIB system working so well with other vehicles in their fleets around the world. They asked us to come and design a solution for this particular vehicle. And the image on the bottom right-hand side typifies the environments that these vehicles operate in an underground setting. These are 60-ton GVM capacity vehicles. They are not on road. There's a fleet of 450 of these vehicles at Vulcan alone, operated by Glencore. And so we've been working with Glencore over the last 12 months on this agreement. We've been developing a product over the last 6 months. We are moving now to prototype validation stage. This is a very exciting development for ABT as it takes us into heavy vehicles in a very focused and strategic way. ABT benefits from a co-funding partner in Glencore, as well as the opportunity for strong offtake for their fleets all around the world. Second largest miner in the world, as you would know. It's a very, very exciting and transformational opportunity for ABT. We retain all the intellectual property developed in this program, and Glencore, after a period of exclusivity of 3 months, Glencore is happy for ABT to take this product out to the market. They know that scaling this product will benefit all end users, and they also know, along with Volvo, that this is a very exciting vehicle platform for highly ruggedized underground and above ground mining applications. So no different to what we're solving for with our core products. It's all about that ingress, that harsh off-road environment, and protecting the brake system from that environment. We're providing our customers with the avoidance of OPEX and maintenance and parts replacement. And we're providing our the operators with really strong driver confidence that the braking system is superior to an open OEM brake system. And we're also protecting the environment from brake dust emissions. This is not our first rodeo into heavy vehicles. You can see here with our wheel end brake development that, the Land Cruiser 70 series, the workhorse of mining globally on the left-hand side, is absolutely our bread and butter. We also, however, make truck products for Isuzu. We make an Iveco product for a garbage truck. We make brakes for Mack, Mercedes-Benz Actros in a driveline format. And now we're designing this brake for the Volvo FMX vehicle. On the right-hand side, you can see the design of this truck brake. It's unique in that it's got a double disc rotor, which gives it that massive capability to hold a 58-ton GVM capacity. You can see here on the left-hand side, this is the Volvo factory drum brake that these vehicles come with, and on the right-hand side, you can see the the ABT disc brake design. Very similar looking brake systems, but very different in terms of the way that they operate. The drum brake on the left is a partly open system, so all that ingress and contamination gets into the brakes and doesn't get out. They need to be stripped and serviced on a regular basis. On the right-hand side, this wet brake system is 100% sealed, protecting the brakes from that external environment. It's also a disc design, replacing a drum brake, which is again a superior brake system for heavy vehicles. We're very proud to be working with Glencore and delivering what we believe is a world-class heavy vehicle brake solution designed for heavy ruggedized industrial applications. And we announced that to the market last month. Our strategy moving forward is building and more stronger foundation for scale and growth. And as you can see from the opportunity that I've just outlined to you, it's really important that we're ready to scale this business in line with our new product development and solutioning for our global customer needs. We will continue to focus on intellectual property that evolves our SIBS design. So as you can see from the truck brake design, we are evolving what's been a 20-year design, very much a well-proven design in terms of a fail-safe braking system. We will continue to work with our very important and valuable blue chip customer base. We are focusing on driving continued international market growth, and we've got a really strong base of suppliers, mainly here in Australia, which has really benefited us through the pandemic. We've got very strong, supportive key investors and shareholders. This is just showing some horizon in terms of what we're looking at out over the next 3 years. We're really focusing at the moment on that foundation strength, as well as delivering really good growth results in FY23. Moving forward, FY24 will see us scale through diversification of our SIBS design and application across a broader range of commercial off-road and heavy vehicles. And Horizon 3 is really driving investment in that technology innovation that our mining customers are very much focused on. And so you'll see some exciting developments around active and passive vehicle safety systems and automation in mining. And we're based in Western Australia. Western Australia is a world-leading autonomous hub, and it's all been driven by the very deep investment appetite from our mining customers. There's some really clever and innovative companies based here in the northern suburbs of Perth that are very much focused on wrapping solutions around autonomous and electrification of vehicles. We are also focused on delivering our shareholders a balanced scorecard of growth, both organic and inorganic. We are continually looking at investment opportunities. And as you can see, we've got a balance sheet that can support that investment appetite. That's all from me. I really appreciate the opportunity to show you ABT and this exciting juncture that we're at in FY23.
Thanks, Andrew. Just a couple of questions. In terms of the export side of the business, you called that out as, kind of one of the growth areas recently. Is that coming from new distribution deals, or is it, now after COVID, kind of re-engaging with existing distributors and maybe renegotiating deals and kind of re-energizing, I guess, the export side of the business?
There's definitely re-energization of and a very heavy focus on closer engagement with those really important partners that we've got on the ground in those important markets for us. So yeah, we're on the ground now in person and driving that business development piece with our partners. However, probably more importantly, we are more and more strategically partnering and engaging with our blue chip mining customers, all of which are based in Australia, our home market, and we're following those strong relationships that we've got in our own home market into these offshore markets. All global mining companies have operations across Australia, the Africa sub-Saharan region, as well as South Africa, South America, and North America. So there's lots of really exciting developments happening in mining. And it's no different to the Australian market. So that's probably been one of the key drivers, is strategically engaging and following these blue chip mining companies into some of these exciting developing markets.
And I know from previous result presentations, you have been trying to, while mining will probably be always at the core, diversify it into some other verticals, heavy construction, civil construction, defense. Can you maybe just talk a bit about, what's happening in that to, try and I guess, get a bit of diversification into the customer base?
Yeah, so look, John Holland provided us with some really great opportunity 18 months ago around providing service vehicles with sealed wet brake systems for underground tunnelling. As you know, federal government infrastructure funding looks very bright moving forward. And so, we see ourselves strategically targeting and benefiting from some of that infrastructure boost. And look, tunneling is happening all around Australia, all around the world. So that's a key arrow for us in terms of diversification outside of our core industry being mining. The other one is we provided the handbrake essentially for the Hawkeye defense vehicle manufactured by French defense manufacturer Thales. So the ABT brake holds the Hawkeye, which is a 5-ton plus light defense vehicle on a 45-degree angle. Again, it's like having a handbrake on steroids. It's a really important product in defense. And it positions ABT as a key supplier for land-based defence vehicles. And again, we are ongoing looking and exploring opportunities for other products in that space. I think as more and more fleets move to electrification, as I said before, brake emissions are going to be the largest pollution emitter and contributor of a vehicle, and sealed wet brake systems fully protect the air environment from those really dangerous brake particulates. And if you think about high density cities where you've got large heavy vehicles operating and frequently stopping, our brake system can potentially go on road and provide a really important protection solution from those dangerous particulates. So look, we presented it at Eurobrake last year. We presented as subject matter experts on brake emissions. Watch this space. It's a really exciting area to follow.
Okay, Andrew, I think we're going to leave it there. We're just up on time. I'm not going to try and squeeze another question in now. Thank you very much for joining us from Perth this morning. It was great to get an update. And we'll keep an eye out for announcements on the ASX platform.
Cheers.
And we do have Adem Karafili from Top Shelf standing by. Adem, if you want to start sharing it. Yeah, it's coming through now. Yeah, I can see the cover slide of your presentation now, Adem.
Okay. Can you hear me?
Yeah, your audio sounds good as well.
Fantastic. Get straight into it, I suppose. Well, thanks for having me on today. Always a pleasure to be able to come and talk about our company and introduce Top Shelf to potentially new investors, new consumers as well. So Top Shelf International is a premium spirits company with an Australian accent, is how we like to describe it. We are a company that has been around since about 2014. We listed the company in 2020, about 2 years ago, almost to the day, actually, right in the middle of, or at the beginning of COVID. So we've had a very interesting time of it over the last couple of years. I'm very happy, of course, to be out and about and free. Our master holdings is myself as well. So my name's Adem Karafili. I'm the executive chairman. I've been with the company formally since 2017, but had been right across the business from its inception, being great mates with the founder and CEO, Drew Fairchild, as well. My background hasn't typically been in alcohol. I was an executive and a shareholder at Swiss Vitamins prior to this, and upon the exit of that business, I've spending most of my time, or all my time, I should say, working within Top Shelf. Top Shelf is a branded Australian spirits company. Ned Whiskey is the original product that we started with. It is an American-style, bourbon-style Australian whiskey. We have a distillery in Campbellfield here in Melbourne, in which we built. We've spent, we've raised over $100 million to get to this juncture, having built the distillery down here in Melbourne with over, a couple of million litres of whiskey on oak. I'll get to that a little bit more about that shortly. Ned has been crowned Australian Whisky of the Year this year, so we're very, very proud of the achievements as we're starting to see, some of the fruits of our labour really come to fruition. And we're always very, very proud to have some external recognition of the work that's been done around our product. Grain Shaker is our vodka. Again, it won Australian Vodka of the Year this year. So again, we're very, very proud of that, and to have some external recognition again around our products and the way we've been able to develop our products, is very, very exciting for us. We call this one out, vodka with character. It actually looks quite different, of course, as you would imagine, to some of the more European and Eastern European looking vodkas in Grey Goose and Belvedere and the likes, Smirnoff. We wanted something proudly Australian and something that actually has a little bit of character. So that was our very second product that we developed. We've developed quite a platform rather than just having product base. We've actually gone and built out a distillery. We've got another third brand too, which I'll get to shortly, which puts us in agriculture as well. But what I would say is, we really set out to change the nature of the Australian spirits category. As you can see on this slide, only 8% of spirits consumed in Australia are Australian. So when you consider wine and beer is around 80 and 85%, and we just thought, well, why is that? And the conclusion we drew was really that there was just nothing available that was accessible to most Australians. And when I say accessible to buy, but also accessible in its price range in which we could deliver. Most Australian spirits, you might be aware of, you've seen, some of the more premium whiskies out of Tasmania. We've seen some fantastic gins being made around the country. And, they are starting to come down a little bit lower in price, but they were largely unattainable for the majority of the country. So we really set about building scale into our business. We wanted to grow, take advantage of the local tailwinds, grow our distribution, grow our channels, grow our portfolio and premiumize and build our brands and activate. And we're having some really, really great success at that early days. But again, it was really coming down to providing a spirit or spirits that were accessible to most Australians. We do have some really interesting tailwinds that support this push from local, I guess, which was really amplified during COVID. Spirits is growing globally as a category. People are consuming less alcohol as a rule, but are buying better, but consuming less. So the total value is continuing to grow while the actual volume declines. And of course, we are in the glass spirits, as you can see here, growing at 1.9%, and the ready to drink, which is the 6.8%. Beer and wine, are probably coming back slightly into growth, but again, that's really built on a craft beer, and a lot of the majors are suffering. As I said, we are a modern Australian spirits company. We have 3 brands. I'll talk to the one on my right, the Agave, in a moment. But there is some consistency in the way we deliver these. Ned, of course, fearless, breaking free from conventions, and that's whiskey. Grain Shaker, as I mentioned, is more exuberant in our vodka. And then our Agave, which is really interesting, which is effectively a tequila. We can't call it that, of course, but it's got this rogue element. And we've just done a brand reveal on that, and it's called Active Treason. It's not in market yet. And again, I'll talk a little bit further about that just a little bit later in the presentation. For our credentials to be a success, we obviously need a portfolio. We're taking advantage of the trends. preferences, our capacity and platform, as I mentioned, really understanding our customer. And we've got an extraordinary group of people, from distillers, agronomists on the farm, our marketers, our sales team. We've really been able to build out quite a unique set of skills that really haven't been developed in this country before outside of the international major alcohol companies. So we're really looking to take them on and really have a platform that can really bring Australian spirits to the people. As I said, the company listed in 2020, so we continue to grow. So this year, obviously, our pro forma revenue, this is from our half year results from our AGM, which we had a couple of weeks ago. So pro forma revenue around 26 million. The branded revenue is up 100%. Gross margins continue to grow. We continue to invest. When we talk about business investments here in brand, we sponsor things like the Australian Open tennis, which is coming up, the V8 supercars. We sponsor a team as well as the actual supercar events. So Ned and Grain Shaker are the first pour. We're able to take Jim Beam out of that sponsorship, the first Australian company to be able to do so. So we're very proud of that. And we sponsor the Maroons for the Queenslanders out there, their rugby league side. And then, of course, the Australian Turf Club up in Sydney as well for those horse racing aficionados. The Australian Agave, we have a farm up in Queensland on the just outside of Airlie Beach on the Whitsundays. We've made, obviously own the land there. We've made an investment in plants. We have over 1 million plants now, with probably a bit more than half of those currently in the ground and growing, ready for their first harvest, probably 8 months from now. As I mentioned earlier, we have a maturing spirit. So whiskey, we've got over 2 million litres of whiskey on oak. To put that in context, it's around 250,000 9-litre cases. It is a very globally significant volume that we have. And then if we were to convert the agave in ground into spirit, there's 2.5 million litres there as well. And that continues to grow. And as I said, it continues to be closer to maturity in which we'll be able to harvest. We have our assets in use. So there's over 150 million. We have a number there in brand assets of 43 million. They continue to grow. We've had a lot of external work come in to value our brands. And so, when you look at, our current trading price and you look at the assets in use, we currently trade at a discount to our assets. Money in the bank, plus an ongoing debt facility. We've been working with a company, Longreach, who's a credit fund from the very outset, really, who helped us establish the initial distillery and have been very, very supportive. And we recently secured an additional 20 million in headroom from those. And as you can see on the left and right of this slide, Ned and Grain Shaker are both the #1 Australian spirits in both their categories. Ned is now the Australian whiskey brand, and Grain Shaker is the #1 Australian vodka brand. These are some of the assets, as I mentioned, in place. We have a distillery here in Melbourne. We can do, substantial amounts of vodka, whiskey, and agave. We are building another distillery up on the farm, which will be ready probably by the end of April, maybe May next year. So we'll be able to process the plants and distill, all on site. You can see the barrel houses and the whiskey maturation as well, with over a couple of million litres of whiskey on oak at 43%. We tend to sell at 40%, so that continues to grow when we think about the bottles in that calculation. And then the largest agave farm outside of Mexico, it's in the top 20, 25, including Mexico. So we're very proud of the scale we've been able to bring to that sector as well. And of course, production, we do have a canning and bottling line that we use as well, that's integrated into our distillery. So we can and bottle all our goods, and we also do some third-party work for some major clients. The brand's really performing strongly in market. As you can see there, Ned's up around 140% in retail scan. We're growing distribution as well. So we've not only are we gaining distribution points, but we're gaining velocity. And so that's really important when you're building brands, and it talks to the strength of brands in market. So we're very, very proud of that. In the markets that we play in, which at the moment are largely independents and Coles, which is Liquorland First Choice, we are the #7 whiskey. So again, when you look at our competitors in Australian and American whiskey sector, Jim Beam, Jack Daniel, Wild Turkey, Maker's Mark, Gentleman Jack, which is another Jack Daniels, and Woodford Reserve, which is another Jack Daniels. So we're really, really getting really close, to those American majors that we really, really know and have loved over the years. Starwood Twofold was the biggest Australian spirit before that in the whiskey category. We've quickly overtaken that in the first 26 weeks in market. So very, very proud of that. And it obviously goes to show that our product is good and there is absolute market acceptance for an Australian whiskey. Vodka is doing extraordinarily well as well, 250% in scan, over 37% distribution growth, and now in the top 10. Only Pure Origin, which is the Coles home or channel brand, and one SKU of Four Pillars Gin is in front of that in terms of the Australian white spirit category. So again, we're very, very, very proud of that, and again shows that the Australians are ready to accept Australian product if you can give them high quality at an affordable price. I've talked about the quality and being recognised. We continue to be awarded. We continue to enter more competitions. We've recently had our first medals in an international competition, in the Hong Kong International Wine and Spirits competition. We'll continue to participate in further competitions as we go look in the coming new year into San Fran, which is a big one, and some in the UK as well. But we continue to do very, very well here in Australia. And again, it's a wonderful achievement for really a company that's relatively young, particularly the fact that our own distillery was only completed a couple of years ago. Sorry, as I continue to go, there is a question that's come up, but I will pick that up as we go towards the end. We do have further capability, as I mentioned earlier, in our canning and bottling lines. And we will continue to work with third-party customers, but we continue to fill out that capacity as we continue to grow as well. I'll talk a little bit about our agave farm. We really think this is an untapped sort of jewel in the crown. Agave or tequila is the most fastest growing spirit category in the world. In the US, it's been growing at 45% year on year for the past 5 years. You can see that in this slide here, where tequila is now overtaking bourbon in the US and is really, really continuing to grow outside of the US as well. So what's happening there is in Mexico now, there is quite a shortage of plants. They are grown quite rustically and grown quite wild. But obviously in Australia, we've had a very, very long history of agronomy and being able to grow things, whether it be wheat, grapes, and all sorts of other products for a very long period of time in a very high quality way. So we've been fortunate enough to be working with the Adelaide University. We're fortunate enough to have a farm, as I mentioned, in Airlie Beach, which is 20 degrees south of the equator. Jalisco, where tequila is 20 degrees north of the equator, so we're on the same latitude, to be able to develop a world-class facility using world-class farming practices that will deliver us a world-class spirit. So Active Treason will be in market in FY24. As I mentioned, this just talks to the scale and the growth of the category. And again, when we think about a new world agave, we really think about bringing Pinot Noir out of Burgundy and putting it into the Mornington Peninsula or into the Margaret River. So it's really creating a new terroir for a plant, and then it being able to bring new world agave to the world. The category, we believe, is ready for it. There's obviously been a lot of celebrity endorsed products in the US. The markets are now really called an agave market. There is more than one type. There's tequila, there's mezcal, racia, and so it's becoming a bit of a fragmented category. So it is an agave category, and we are really looking forward to playing our part in that. And this really talks to the company and the company performance. So we continue to grow, as you can see there, from FY19 to 22. Brandon revenue last 12 months, 23.3 million. Again, it's really in hyper growth, and we really focus on our branded revenue, which is up 100%. We've a long way to go. We have some absolutely more distribution points to gain. We're yet to sell a product within the Dan Murphy's or the BWS network through Endeavour. So we continue to talk to them about ranging for the new year. So hopefully in the new year we'll have something positive to say about that. Regardless of that, we continue to work and grow. We continue to develop our marketing strategies. Again, regional has been really big for us, where we've had television running through the NRL, AFL Grand Finals. We'll continue to invest in our brands and continue to really bring these Australian spirits to the market. I'll sort of cut through and push through quite a bit there in a relative short period of time. It's hard to sort of capture everything about the organisation in such a brief amount of time. So I thought it would be best to leave as much time to questions as possible. I might go to a couple of questions here. So there's a couple that have come through. So I'll read them out. TSI underlying loss last year was over 20 million EBITDA, excluding the fair value gain. What revenue scale will we break even? Again, as we look at our loss and the investment in the platform, to stand up a distillery from scratch, we've had to invest in front of that revenue curve quite a lot, obviously. We've made no bones about that. We've raised over $100 million. Most of that, as you can see, is actually in the balance sheet. We talk about the fair value gain. I know it's a non-cash item, but I should point out that when we do bring agave to market, the cost of goods that comes into that is also non-cash. So you look at your gross margin as a cash margin from your agave product, and your cash margin is going to be higher than your actual stated gross margin. We are growing. When we think about break even, we will break even in some months, even this side of Christmas. Obviously, coming in November, December, our busiest months of the year. But we will look to continue to invest in front of that curve. But as we grow, we're certainly getting closer and closer to that point. But I think if you look at the operating leverage we're getting, if you look at our cost base, it has not grown at all over the last 12 months, while revenue's grown at 100%. So I think that can go some way to responding to that question. There's another one here. Your gross profit is almost offset by your selling expenses. Therefore, you're barely making any margin on your sales. How are the unit economics of your business sustainable? Again, I'll talk to that. It's a fair question. But the gross profit will continue to grow. As we continue to build out our products, there is a premiumization and a price component to that. So we continue to see our actual margins grow. There's been a push really, with some of our products, even in the RTD, the NED 6% can has become the bigger SKU as opposed to the 4.8, which is, again, a higher margin SKU. NED 700 ml is selling, at an everyday price at around $62, which is up $5 or $6 from where it was even 12 months ago. And, we continue to we've got Green Sash coming out into market and some other products that are a bit more, a little more expensive as well, which continues to help that margin profile. When you look at those other selling costs that are captured there, I called them out before as sort of business investment. We have invested in things like the Australian Open, again, way in front of the revenue curve, but it was imperative in getting Grain Shaker ranged at the likes of Coles. We own, a lot of the late night Melbourne late night high volume vodka venues as a result. The supercars, again, we invested that early. Again, it helps us get ranging. It helps bring some awareness to our brand. It doesn't mean you have to continue to grow that base. And in fact, you know, as they come through, you can start to reallocate those costs into other ways that might be a little bit more efficient in terms of growing, you know, margin and growing volume. So we're very, very comfortable with the decisions we made. They were very, very, very much deliberate. And so, you know, we, again, as I said, have not seen any growth in our cost base, including that over the last 12 months. And we won't expect to see it grow, you know, in the next 12 either. So we're very, very comfortable around the economics of that. It's why we've been raising money. It's why we've been bold. It's why we've been the fastest growing Australian spirits. It's why we are the biggest in both categories that we're playing in right now, and still have the opportunity to deliver, you know, another spirit, you know, off this exact same cost base. I might take a breath if anyone's got any further questions.
Can I just jump in with one? Because I saw an interview with you somewhere else, and you were talking about the export opportunity, and you were liking it. If we take, you know, Australian spirits as a whole, you know, it's maybe where Australian wine was back in the 80s and 90s, where it started to, you know, venture out and go global. So maybe just touch on what you're thinking in terms of, you know, potential for exports in the next, you know, 12 to 24 months.
Fantastic. Great question. So we do liken ourselves very much to the Australian wine industry was, you know, 30, 40 years ago. The Australian distilling industry has grown enormously over the last 5 years even. It's gone from having roughly around 30 to 40 distillers to over 350 distillers nationwide. It is very, very collegiate. We work very, very closely as a group, as the Australian Distillers Association, as well as the Spirit and Cocktails, which I'm on the board of, but it includes the likes of Diageo, Pernod, Brown-Forman, Beam Suntory as well. And so, you know, they all believe, even the internationals believe, that a strong Australian spirits category is good for everyone. And so we are working really closely together. We're working with government, we're working with Austrade in really building out the opportunity to take Australian spirits to the world as a collective. The brands and the categories are big enough for us to all compete and to work together with. And so there's been an enormous amount of work that's gone in, an enormous amount of support. So, you know, we're looking at the US, we're looking at Malaysia, we're looking at China, we're looking at Europe. We've had an enormous amount of inbound inquiry from Europe, particularly around the vodka. As you know, there's been a bit of a pushback on, you know, some of the Russian vodkas, of course, after the Ukraine. So even some of the macro trends are sort of working in our favour. So we really believe that there is a big opportunity to behave very much like the wine did. We have great support from government, as I said, and great support from industry, and we're all working together in order to make that happen.
And then can I just ask a further question? You know, you said you're in talks with Dan Murphy and BWS. Is that, you know, not getting into those at this stage? Is that because of their own internal processes where, you know, they do annual range reviews, or you know, what is their kind of
so we
you know, if you're in calls, I would have thought, you know, why would I not have a high selling product that my direct competitor has? It doesn't really make sense.
So the simple answer to the question is we can only sell the whiskey that we've had available to us. So, you know, we only have whiskey that we can sell today that we put in barrel, you know, 2 or 3 years ago. And so it was quite a decision at the time. We couldn't actually do both. And so it was an opportunity to work with Coles, in which we've been able to build out the brands. And now we're working with Endeavour as well, going through their range review process, as everyone does, but really working with them to show, and as you said, when we show market data and proof of concept, it makes these discussions much easier to be had. We now have enough whiskey in which we can supply the entire market, and that's what's really impacting the timing, and that's why we have driven timing, you know, to now. So we're very, very comfortable. It's all part of the plan. And as I say, it continues to roll the way we expected it to. We haven't had any confirmation, so I really don't want to preempt the work that Endeavour doing on our brands, but we are working with them, and we are hopeful and quietly confident that we think we've got an offering that will work in their stores, which is BWS and Dan Murphy's as well.
Another question from the audience.
There is another one. Why not pitch your whiskey at the premium end of the market, which is better unit economics? Now, look, there's a great question, but there's also what we talk about is fishing where the fish are, right? So there are some people who like to pitch their whiskey at $250 a litre or so on and so forth. The reality is they're playing in maybe 0.1% of the market. So you can price yourself out of the opportunity. And when you look at the volumes, and this is where we study a lot of data, we look at where the volumes are, and that's where we've chosen to play, because that's where you get scale. There's enough niche players in this country. We didn't want to participate in that category. We believe that we've got a product that will deliver great margin. Of course, you're always looking to optimize your mix, which is why we've got a good, better, and best strategy with Ned. We call Ned OG, is the original gangster. And then we've got the green sash, which is just released. So that will play at about a $70, $75 price point. And we'll have a better to come out next year as well, which will, probably be in that 90, 95. But at the same time, we still expect, our everyday Ned at $62 to be our best seller. And we work on our unit economics. When you think about that, at the moment, we think it's cost us around, $9 a barrel. We can go down even lower than that. When you look at some of the publicly available information of some of the others who are paying $115 a barrel, which is an alcohol unit, you can see that, the economics of what we're doing and create an efficiency through our distilling, which we continue to work on, by the way, as a new distiller. We think we can actually continue to lower our cost of goods in order to, keep supporting having our products, in the affordable range, which is where all the volume is.
And then one final question from me, Adem. It deals with, the big hospitality groups, like Maryvale in Sydney or whatever. Yep. Where does that fit into the kind of overall strategy?
Yeah, look, they're very, very important. So obviously we're a bit landlocked during COVID. So we've had some really big wins, I guess, down here. 70% of vodka consumed is on premise. So, those big on-premise accounts are very important. We have a lot of big volume accounts here in Melbourne. We couldn't really get to Sydney at the time. We are ranged in Maryvale now with Grain Shaker. We're in talks with them, of course, around active treason. They've done something like 75,000 margaritas this year alone, Maryvale. So they're an extraordinary organisation with extraordinary volume potential. And so they do fit in. Of course, we're talking to them. As I said, Grain Shaker is in their venues already. But again, you've got to look at ways in which we can work to work with them into, cocktail lists, etc. Vodka used by the big guys to, that's how they anchor their volume commitments into big venues. They do a first pour arrangement with their vodka, and then they look to get the back bar. So we're just working with them. Again, it's an integral part of our plan. We've had some really good success early on, but we'll continue to look to build.
I think we'll leave it there. We're actually bang on time. So we all at a halt there. Thank you very much for coming in. It was great to hear the story firsthand. Hopefully you got a few customers as well.
Yeah, hopefully. No, it's our pleasure, and thank you very, very much for having me on. And as I said, I always happy to talk about Top Shelf and our brands. And the more we can get people to understand even those questions around the unit economics and around our P&L, I think it's important for investors to hear it from us that it's all been part of our plan and our planning as we continue to grow and look to get to that break even and then profitable periods.
Perfect. And then we'll leave it there. And I'd like to wish everybody a good holiday, Christmas, New Year. This is the last Coffee Microcaps event for 2022, but don't fear, we'll be back in 2023.